So I told you, we as real estate brokers do this. Oh yeah, there you go. I didn't even see the question. And there I go again. We as real estate brokers do this. And as I said, when we do this, for the CMAs, it's a little more of an informal version. Not as many details. We don't make as many adjustments, but it is still something that we're expected to be able to do and be competent in it. And as I said, we indicate it as a range, low to high. We don't ever arrive at a single conclusion like an appraiser does. And so this is something we definitely would do for both buyer clients and seller clients, because we need to make sure that they are both being priced right? That the buyer puts an offer in, that it's a reasonable offer based on the market, and same thing for a seller. That, we kind of know what would be a reasonable list price based on the market. Now, I told you, real estate agents in North Carolina, this is part of that competency piece. And so you are expected to know how to do this in a competent manner. One other thing to caution you of on the test, folks. Yet again, if we're looking at textbook versus real world, I would say that this kind of contradicts each other. But for the sake of the test, if you were asked what is a better comparable, and it gave you the option of a property that was identical on a similar street versus a property that was different by one bedroom on the same street, you're going to pick the one on the similar street. And the reason is they always test this as picking the one with the fewest adjustments. So let me give you an example of what I mean here. Which is the best comparable for a 3-bedroom, 2.5 bath in Durham, North Carolina? Yeah. So if you listen to my words, B is going to be the correct answer here. In the real world, folks, I would tell you A all day long. In the real world, I'm going to pick the same street. That is going to be, it's especially when we get down to neighborhoods. Certain neighborhoods sell differently than other neighborhoods. So I would much rather stay in the neighborhood and have to make an adjustment for a bedroom versus going out of the neighborhood, right? But for the textbook, for the test, as fewest adjustments as possible. So if the adjustments are none and it's similar, go with that one versus the one where you have to make adjustments. Everybody good with me on this?
So you're saying like the difference of a street is not considered an adjustment?
Not if it's deemed similar. If it's, it has to be similar market. So when it's saying similar, it's stating it's similar enough where you don't need to make an adjustment for. And that's where, you're not making any adjustments for that one versus the other one where you'd have to make an adjustment for a half bath. Yeah. So here's the next one, folks. This is the cost approach. Now, this is the one right here. This one is hands down the reason why this whole valuations section sucks. Just to put it lightly, right? There's so much in this cost approach method that I think is overkill information, but they love to test you on it. And it's so weird. There's so many different pieces. It's not nice. And so let me give you the simple version of this, and then I'll explain why it's not that simple. The simple version is, and I told you this is more commonly used for unique properties that are not necessarily income producing, and there's not necessarily a lot of comparable sales to look at. And so I said things like churches, schools, hospitals, and more often than not, it's used for insurance purposes. So we can figure out how much insurance coverage we need on a building of this type. And so the way that this works is we basically take a look at the building and we say, okay, what would it cost to build this building brand new? Okay, that's where we start. What would it cost to build this building brand new? But since the building is not brand new when we're doing this, then we would depreciate some value from the building. meaning lowering the value to account for its age or its deterioration or something else. Here, so what would it cost brand new minus depreciation, add the value of the land back in? Why? Because land doesn't depreciate. It's infinite. It's forever. It's ongoing. So I'm going to say that again. What would it cost to build this building brand new minus depreciation, add the value of the land back in separately? And that's how we determine the value. The problem with it is there's so many different methodologies of doing that. And it's absolutely ridiculous that they bring it into this curriculum in any way, shape, and form, because it's just not realistic to talk about it. So let me kind of talk about one of the ways that we could potentially depreciate it. When we're dealing with depreciation, there is a couple concepts you have to understand, and that is, one of them is the effective age. The effective age of the property is how old do we treat it as. And so buildings, sorry, I had to listen to some sounds there. Buildings are said, just kind of like equipment, are said to have what's called a useful life or an economic life. And so you always look at a correlation between like how long it's useful versus how old is it acting. And it's kind of a silly thing because it has nothing to do with how old it actually is. Folks, can we all agree that there is properties built in the late 1800s, early 1900s that are still standing and functioning today? Sure. Now, on average, the economic life of a real estate building is 60 years. So it's kind of funny to say, oh, they're on average good for 60 years, but we have plenty that are fine that are hundreds of years old. And that's because effective age has zero correlation with how old it actually is. It's how old is it acting? Because if you maintain it, if you repair it, if you take care of it, it could effectively be a lot younger than what it actually is. And so as you do repairs, you can actually roll back the clock on the effective age. And so that leads us to a method of depreciation called the age over life method. And so, for example, if we said that a building had an economic life of 60 years, what that number is really stating is, if you don't do anything to update this building, it will probably be completely useless in 60 years. That's what we mean by economic life. If we then look at a building and we determine that based on its features and how it's been maintained, that its effective age is 20, the age over life method, you basically take how old it acts versus how long you expect it to be good. In this case, 20 over 60. And that tells you how much to depreciate this building by. And as I'm teaching this, this is why I hate this section, because it doesn't make a whole lot of sense if you're not familiar with this. But let me show you what I mean here. 20 divided by 60 means that it has depreciated 0.333 repeating, or 1/3 of its life. That's what this breaks down to, 1/3. And so if we said, because let's go back to where we started this building was worth $800,000 brand new, but it has an effective age of 20 and an economic life of 60, we would say that the value left is 0.66666. You have to understand what you're taking away, the 0.33333. So if you just take your, 0.333 whatever times your $800,000 brand new, this is how much you're depreciating. In other words, the building is not worth $800,000 because its effective age is 20. So how much is it worth? It is worth $800,000 minus the value you had to depreciate. And you could have also just put times 666, whatever. And then I told you would add the value of the land back in because we don't depreciate land. So what did it cost to build the building brand new? Minus depreciation. If the land's worth $80,000, add that in. And that would be an example of the cost approach using the age over life method of depreciation. And it gets worse. bother doing the math. Y'all can add that, but let me show you a couple other reasons why this section is questionable, and then I'll give you a couple more examples. Well, here, actually, I want to show you a couple of things while I have this visuals pulled out. But why the cost approach is really bad. Before I show you that, this is a copy of an appraisal. And so we were just talking about the sales comparison approach and how that, we as real estate brokers don't do it quite as in depth as appraisers do it. This is just what it looks like for an appraiser. All these adjustments are made based on an appraisal. And so they've got a whole lot more adjustments than they would make over us. But then, as I said, they use a method of reconciliation to arrive at a single value. So if you look, there is their overall number that they've concluded that the property is worth, $265. But you can see that they did two different methods. The cost approach that we're looking at right now, and they did the sales comparison approach. And of course, reconciliation means weighted average, not simple average. So they gave the most guff to this and considered that a little bit. So I just wanted to show you the appraiser while we were scrolling through. But here's what I want to show you about the cost approach. And this is where, hands down, it is the hardest part about this entire section. This is an example of a cost approach. Now, this does not use the straight line method because they can end up going and doing what we would call itemized depreciation, where they're taking a look at physical attributes and they are subtracting it out based on certain things. So we're going to talk more about that in a second. And then, of course, the way that we value the property is different too. So there's the square foot method, the unit in place method, the quantity survey method. So I'm going to get into all these more in just a second, but I'm telling you, this is why I stated last week, this is one of those sections that I would suggest you listen to again and again, because I can't sit here and talk about it for the next 3 hours. So I'm going to try to simplify it to the best of my ability, but you will need to replay this because there's just so much crap in this cost approach that can throw you off on the test. So before I go back there, let me come back to another method of depreciation. So we just did the age over life method. The next one is called the straight line method of depreciation. And so in this example, if we had a property with a land value of $30,000 and a building value of $90,000, remember we don't depreciate the dirt, so you keep that separate. And we said that the building had an economic life, yet again, of 60 years. The straight line method of depreciation would be take the value of the building brand new and divide it by its economic life to figure out how much you would depreciate each year. It's called the straight line method because if you were to chart it on a graph, it would go down a straight line because every single year it goes down by X amount. And so if you were to use that methodology, you could then take your annual amount of depreciation and multiply it by its effective age. So if we said that this property acted as if it was 15 years old, you would take your 1,500 times 15 years and depreciate it by 22.5. But that's not the value of the building. That's how much you take away from the 90,000. So what is the value of the building? 90,000 minus 22,500. And then you would add the value of the land back in, which was 30,000. What is the total value of this property? 97.5. There is an example like this in your practice final, in your practice final. And I think there might be one in the math packet that I can kind of show you. Because it's not necessarily hard math, but it's just such a weird concept that it's hard to kind of string it together. Let me give you another example here. In this example, $400,000 property has a land value of $90,000, building value of $310,000. The economic life is 50 years. How much would your straight line depreciation be on this scenario? A lot of consistency out there. Yeah. Folks, all you're doing is you take the value of the building. What would it cost to build this building brand new? It is $310,000 for the building. Divided by its economic life of 50 years, you would depreciate it by $6,200 a year. And so if I told you that the effective age of this property is 10 years old, how much value are you going to be depreciating? A lot of you saying 62,000 in the chat. Yeah, that's how much you're going to be depreciating. That is correct. So final question, okay, bonus round. What is the total value of the property based on the cost approach with the scenario I just gave you? There you go. 338, folks, because remember, if this is your straight line depreciation, $6,200 a year, I told you I had an effective age of 10. You multiply that by 10 to get how much you're going to depreciate it by, but that's not the value of the building. You would have to take your $310,000 that it would cost to make brand new, minus your $62,000 in depreciation. Value of the building is $248, but then you have to add the value of the land back in because we don't depreciate that. So based on this straight line method of depreciation, what is the value of this property? Based on the circumstances I gave you, $338,000 based on the cost approach. Now the next slide was just one of the steps, and it's just showing you, I added it in so you kind of had a better understanding of how it goes. But as I mentioned, these are very linear, very straightforward methods of depreciation. And of course, appraisers use these, and it's more complex than what we would ever be doing as real estate brokers. What you got, Ashley?
Could you take the property like that's listed, so the 400,000, and then just subtract what the depreciation value is and get the answer, or no?
Yes, as long as you understand that the depreciation was found on 310, you could do that.
Okay.
Yeah. The danger in not separating it out is if you were to just take the 400,000 and then divide that by 50, you've screwed up, right? But yeah, I mean, as long as you took the 310 separately, got your straight line depreciation, and then went back where the land was added back in and subtract your building's depreciation, yeah, you get the same number.
Okay.
Yeah. So here's where it gets ridiculous, okay? I mean, this is bad enough, and then it gets worse. I told you there is the itemized depreciation, also called the breakdown method of depreciation. And this is literally where an appraiser is going to look at certain attributes of the property and kind of assign a depreciated value to a specific feature or lack thereof or something. So the first one is called physical deterioration. The siding is damaged. The roof needs replaced. There's some hairline cracks. There's things that are damaged to the property. And so, of course, that decreases the value. Now, when we talk about physical deterioration, it can be both curable and incurable. But I want to clarify something. Folks, everything is curable if you have enough money. Let's just be completely honest. Everything's curable if you have enough money. So when we say incurable, it means it's not cost effective to fix it, right? Painting and patching siding and new roofs, those are all curable deterioration. It is cost effective to fix those things to keep your house up. What would be an incurable would maybe be like major foundation issues on an older home. If it costs $200,000 to fix the foundation in a house that's only worth $200,000, we would call that incurable. It's not worth doing, but you could. So physical deterioration could be curable or incurable. Another way they break it down is what they call functional obsolescence. Weird word. Basically, it means no longer desirable, ergo not as valuable. Let me give you a prime example. Burnt orange shag carpet and pink and teal bathtubs and toilets. Okay, yeah, Lena, it's not really desirable, is it? Still exists, but functional obsolescence can also be deemed curable versus incurable. Folks, a teal and pink bathtub and toilet from a house that's from the 70s, that is very curable. Bathroom renovations are not that expensive in the grand scheme of things, so we would consider that curable. Okay, functional obsolescence, not a desirable feature. So updating the fixtures may be a curable version. Incurable may be one bathroom in a house where you can't really add another bathroom. You could always do an addition, but it may not be cost effective. And folks, while one bathroom was a common thing back in the day, nobody wants a one bathroom house anymore. It is not desirable in any way, shape, and form. And so functional obsolescence, yet again, could be curable or incurable as deemed by an appraiser. And then the last breakdown method is what we call economic or locational obsolescence. And this is an external factor, like being next to a hog farm, a highway going through your backyard. These are things that are, of course, going to lower the value and desirability of the home, but you can't fix them. So these are always incurable. You do not have the money to ask somebody to move the dump or the hog farm. So these are always going to be deemed incurable. So now that you kind of understand these, let me go back to that example that I was showing you in the textbook. This would be an example of a cost approach using the breakdown method. Okay, first, they've found the replacement cost of this building brand new using the square foot method. I'll get into that in a second. The land and its improvements are separated out. Here's the value of the building by itself, brand new. And then here's your breakdown depreciation. Physical depreciation, curable, $4,000. Incurable, $9,750. Functional obsolescence, they didn't really break down whether it was curable or incurable. It's irrelevant, really, at this point. $2,000. No external depreciation. So that gives you total depreciation of $15,750, taken away from the cost of the building brand new, and then you add the value of the land back in. Yet again, why do I need to teach you this? I don't know, but it's on the test. Gotta love it. This is way outside the scope of a real estate broker in the real world, so the fact that I have to teach it is kind of a silly thing. Let me take it one step further, and then we'll move on, because it's just not worth spending a whole lot of time on, but it's definitely worth reviewing. I told you there are multiple methods of determining what the building would be to build brand new. The most straightforward is the square foot method. And so what they'll do for the square foot method, let's just say we're looking at a hospital, folks. They would go and they would look at a hospital that was recently built. And let's say that a hospital was just built for $12 million. And it was a 15,000 square foot hospital. Well, you took what it cost to build, divided by the amount of square feet that it was, 15,000, which gives you a price of $800 a square foot. And so then if an appraiser is looking at a building that is, you know, a 10,000 square foot hospital, they say, okay, well, the average price per square foot of this recently built hospital is 800. So let's take your 800 a square foot times your 10,000 square foot hospital you have, and they're going to determine that the cost of your hospital brand new would be about $8 million. So that's one way of determining what would be brand new before they depreciate it out. This one makes sense. The other two do not make a lick of sense in any way, shape, and form. You ready for this? The unit in place method. The replacement cost of a structure is estimated based on the construction cost per unit of measure of individual building components, including materials, labor, overhead, and builder's profit. The unit in place method, most components are measured in square feet, although items like plumbing fixtures are estimated by unit cost. So in other words, they're going to say, oh, it's going to be, you know, $120 a square foot for flooring. It's going to be, you know, $180 a square foot for framing. It's going to be, you know, however much per cubic yard of concrete. So they basically look at all the different materials and construction and labor costs, and they say this is what it costs to install it all in. And they quantify it, you know, kind of based on the different units, the different types of things. And it makes no sense. Even worse than that one is this one, the quantity survey method. An estimate is made of the quantities of raw materials needed to replace the subject structure, lumber, plaster, brick, etc., as well as the current price of such materials and their installation costs. In other words, we're going to need 16,000 pieces of lumber. We're going to need 18 tons of concrete. We're going to need 82,000 screws. It's going to cost this much to install it. It makes no sense. Folks, nobody in their right mind as a real estate broker could do this crap, and it doesn't even make sense. But if you see the square foot method, the unit in place method, the quantity survey method, these are all methods of determining the value of the property brand new. And that's what it comes down to for the cost approach. What would it cost to build this structure brand new using one of these methods, minus depreciation, add the value of the land back in? That's it. There's just so many different things they could throw at you on the test, so it's kind of horrible. This is the same example I just showed you. Let me ask you a question to see if you're retaining any of these crazy, nonsensical pieces of language that I'm throwing at you. This occurs when you have design features that are no longer desirable in the current real estate market, such as outdated kitchen fixtures or an unusual bedroom to bathroom ratio. There you go. Functional obsolescence. Functional obsolescence. Now, this last one, I like this one. You probably are not going to like this one, but to me, it makes good sense compared to the other ones. But it still does have some math involved to it, and you may see one of these on your test. The income capitalization approach is where we value something based on the money it makes. If we're talking about like a 30-unit apartment complex, folks, it's not just valuable because of the structure. It's valuable because it's a business. Right? Their monthly incomes or annual incomes. It's like running a business. If you're a property manager of a multi-unit building, you're basically the general manager of a business, is what you are. And so what we do is we say, okay, here's how much this grosses, and we subtract out some different things. So let me introduce the way that we calculate this, okay? There is a mnemonic, and this one's actually good, because I told you there's some mnemonics I've taught y'all that have been terrible and some that are good. This is a good one. The mnemonic is, please vacuum every office nightly. If you can remember that, you'll be in good shape for the income capitalization approach. And so let me just give you an example of what I mean here. If I told you This was a 22-unit apartment complex. And every unit rented for $1,700 a month. How much is that? Some of y'all tell me 37.4. So if you take our 22 units, multiply by 1,700, that is 37.4. Now here's the thing, folks. When we are dealing with business reports, we are always looking at an annual report. Okay, we don't want to know the monthly, we want to know the annual report. So how much is it a year? Looks like 448,800. Multiply by 12. We're dealing with 448,800. Now, folks, let me ask you a question. And I want you to think about this. I'm not referring to expenses. We'll get there. Listen to me. I'm not worried about expenses. Here's the question. Are we actually grossing this amount of money? Why not?
Vacancy.
There you go. Folks, this is the amount of money that you could gross in a perfect world. If every single unit was rented and if every single person paid on time. Good luck. So we call this potential gross income. You have the potential to gross this amount of money, albeit not very likely. Everybody with me? So you take what you could potentially gross. So that's your top number. That's the P of the please vacuum every office nightly. And so now what you've got to account for is what we call vacancies and losses, as you just told me. And so what a test question will say, it'll say something like, assume 6% vacancies. There's no standard. We're not worried about that. It'll tell you. So if we said assume 6% vacancies and losses, that is 6% of your PGI. So you take your 448,800 and multiply it by your 6%. And so that is what the V is. Vacancies and losses get subtracted out. 26,928. And so when you take your potential gross income of 448,800 and you subtract out your vacancies and losses of 26,928, that leaves us with your effective gross income. What you realistically are going to gross. Effective gross income, called your EGI. Now you've got to account for your operating expenses. Now, folks, if I told you that your operating expenses were $7,000 a month, what do you need to do with that information?
Multiply it by 12.
There you go. If they are $7,000 a month, we're looking at an annual report. So you can't just leave it as that. So 7,000 times 12 gives us annual operating expenses of $84,000. And that leaves us with the magic number, which is your N, and that is your net operating income. Net operating income. So you take your effective gross income of 421,877. Subtract out 84,000. That gives us an NOI of 337,877. Now, folks, here's what I want you to understand. We're going to talk about the cap rate in just a second, Beverly. Hang tight. Here's the thing. What we're saying right here, right now, is that this budget camp, there you go. If this building was being sold, folks, let me ask you this. How many of you would love to own a building that makes you $337,000 in passive income every year? Doesn't that sound nice? So before I even teach you how we value this, do you think that if I'm selling this building, I'm probably going to sell it for a lot of money if you're buying the right to almost $400,000 in passive income a year? Don't you agree? Uh-huh. So I just showed you how to find the NOI, which is a net operating income, and that's the magic number. Now, folks, what does come into consideration is what we call the cap rate. This is, in fact, called the income capitalization approach. So if you've ever heard of a cap rate in a simplistic term is your year-on-year return on your investment. That's the way to look at it. And so if I told you, and I want you to kind of keep it separate from what I'm talking about right here. I'm just going to give you another metric. If I told you that I purchased a building for $8 million at a 8% cap rate, what that means is that while I spent $8 million on it, I make 8% of $8 million in net operating income a year. And so 8 million times 8%, that means this investment that I purchased is making me $400,000 or $640,000 in net operating income a year. And so here's how cap rates work, folks. Appraisers will look at properties, what they sold for, and what their NOI was, and they will use that to determine a cap rate. And this is no different than any of the math that we've done before, because if you were to take your 8 mil times your cap rate, that's going to equal your NOI. And so really, if you take your NOI and divide it by your sales price, that shows your cap rate, right? 640,000 divided by 8 million, 8% cap rate. So you're probably not going to have to find cap rates, folks. So what a test question is going to look like is exactly what I just walked through with you. And then it's going to say something like, assuming a 9% cap rate or something like that. And so here's the magic thing. Once you find your NOI, all you have to do is take your NOI and divide it by your cap rate to take your value. Why? Because the value times your cap rate equals your NOI. And so if you know the cap rate and you want to find the value, divide by the cap rate on this side, divide by the cap rate on this side. So in other words, if we're at a 9% cap rate, and I said, what is the value of this building based on the income capitalization approach? Take your NOI, this number, 337,877, and divide by the 9% cap rate I gave you. What is this property worth? $3,754,188. And yet again, remember, the cap rates are year-on-year return on your investment, so you can check your work. Take this number, multiply it by your cap rate of 9%. Is that how much I'm making each year? Yep, we're good. We did it right. What you got, Donna?
Just checking in, Seth, on what you said. On the test, will we just need to use the formula, or will we need to work through the problem? Please vacuum every office nightly.
You could be either. So understand that the magic number is NOI. So that you may get a test question, Donna, where it gives you what the operating expenses are, what the potential gross income, but then they sometimes sneak in what the NOI is. And if they give you the NOI, you don't need to work through any of that crap because you have it already.
Right, okay.
Yeah, but sometimes you will have to work through all of it to find that NOI and then just take that NOI and divide it by the cap rate.
Okay, thank you.
Yeah, for sure. So it's got a lot of steps, but it's not really that difficult. And that please vacuum every office nightly mnemonic does kind of help. And so, as I said, the cap rate is typically determined by an appraiser. And so, yeah, for the sake of the test, you're typically given the cap rate. But if it asks you to find it, an appraiser, and I'm going to actually show you that. Let me show you the example on my slides. If you look at, well, it's on a couple slides from now. As I said, if you were to look as an appraiser for a given type of property, let's say we're valuing an apartment complex, you're going to look at similar apartment complexes that have sold, and you're going to take the NOI, because folks, when you sell a business, you got to open your books. You got to tell people how much you make. It's kind of like, that's why a lot of CEOs go to jail, because they'll lie about how much money a business is making in order to sell it and all this kind of stuff. So you got to open your books. And so when you look at a commercial property that's sold, you just take your NOI. If we say that it had, a $200,000 NOI and divide it by, what it sold for of, $3 million, we can just look, and that's going to tell us our cap rate. So this would be like a 6.7% cap rate. And, sometimes appraisers will average these out. That's all it really is. But let me give you an example of when you can skip some steps. Now, I want to clarify something, folks. There is something that is never, ever, 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 ever included in your operating expenses, and that is debt service. What is debt service?
Mortgage.
Yeah. Your principal and interest payment. And I'll tell you why it's never included. Folks, in this fictitious scenario where I just had this property that we said had an NOI, what was it, of $337,000 or something like that here. No matter who owns this property, if it's maintained the same, that's their NOI. If Brad owns it, that's his NOI. If I own it, that's my NOI. If Savannah owns it, if Tara, if Brianna, if Cheyenne, doesn't matter, right? But can we all agree that if Elon Musk was to buy this building in cash money, he doesn't have any debt service? But if Savannah buys it with, a 10% down payment, she's got a decent loan that she's got to pay each month. And so we value it based on NOI. Why? Because that is a universal metric that doesn't include debt service. Debt service is going to be different for everybody depending on how much down payment, what your interest rate was, things of that nature. So debt service is never part of your NOI. So if you have your effective gross income and you have your operating expenses, you skip some steps, right? It's not always going to be start at the potential. And so here's an example of what I mean, folks. Take a look at this question and tell me what the NOI of the property is. And don't panic. Just do with what you have. Whatever information you're given is all you can answer a question with. Yeah, there you go. Got a lot of consistency over in the chat. 45,000, folks. We started saying, 12 units and generates 100,000 and owner spends 55, but we're not looking for that please vacuum every office nightly thing here because they really only gave you two numbers. And so you can only work with what you got. So your $100,000 minus your $55,000 in operating expenses would give you 45,000. And so sometimes you're not going to have to do all the steps. And sometimes, you could see the test question, as I said, that gives you the NOI already, which means you don't have to do any of the steps. You just take your NOI divided by your cap rate. Bill says, is the MLS used for rental comps as well? Yeah, absolutely. And a CMA can be done for rentals as equally as it can for sales, right? You would just make adjustments based on rental features. So, this one rented for this much with 3 bedrooms, 2 baths, and you'd make adjustments same way. So, yep, absolutely. So, we're talking about the income capitalization approach, and we just kind of gave you a little bit of insight into a partial one where you didn't have to do the full numbers. Here's the slide I was looking for earlier, but it wasn't up yet. This is just an example of how they would find cap rates. As I said, an appraiser would look at past sales of investment properties. And so we would know what they sold for. We would know what the NOI was. And you just take the NOI divided by the sales price, and that gives you your cap rate. So in this example, if you had 3 cap rates that you found, a lot of times they would just average the 3 cap rates together to find a, kind of the middle of the ground appropriate cap rate for that type of investment. Add the 3 together, divide by 3, that's your average. And so now here's another partial for you. If we said based on these 3 cap rates, the average was 9.23% cap rate, and we had that other property with $45,000 in NOI, what would you tell me the value of this property was? Here you go. Getting a lot of consistency in the chat. Ashley says, do you round up to the nearest 150? Yeah, I would round up just to the nearest dollar. We're not ever going to value a property at some change, so I would round up to the nearest whole dollar. But as I said, it'll never come down to rounding on the test. We'll always kind of tell you what to do, or you'll have a good insight, to say the least. So all you do here, take your NOI divided by your cap rate, and that is going to be your value based on the income capitalization approach. In this case, I got it, $487,541. There you go. This is just a more in-depth example of what a, operating expense report would look like to find the NOI, and then, extrapolating it out. You don't really need to worry about that.
Can you do that formula? Not formula, that calculation, the previous question.
Can I do what now?
Yeah, because I got a different number. So you have to divide by 4.
$45,000 NOI divided by 0.0923, which is your cap rate, 487,541.
Okay, I got you.
What you got, Bill?
Do you have a non-owner occupied fourplex? Can you use the cap rate to method to figure the value?
Yes. The thing is, and that kind of segues into what we're about to get into, you would typically use the income capitalization approach for more often things larger than a fourplex. However, you could use it for a fourplex as long as you had detailed reporting. It's just most of the time when you're dealing with, 1 to 4 unit rentals or investment properties, people don't have nearly as much reporting. And so they're going to use this method right here. And that is called the gross rent multiplier. Now, folks, this has a tendency to confuse students quite a bit, and I don't know why, but this is kind of similar. It's just a very simplistic version of an income capitalization approach. The gross rent multiplier takes a look at what properties sold for that were investments, and it looks at it as a correlation of their sales price versus what they were being rented for. That's it. So before we said the NOI divided by the sales price gave us, the cap rate. But all we're saying here, folks, is if, let's say a property sold for $400,000, but when it sold, it was an investment property and it was being rented for $2,200 a month. You would find the correlation of that data to find what's called a gross rent multiplier. So $400,000 divided by the $2,200 a month that is being rented for would be what we call a GRM, or gross rent multiplier, of 181, or I guess 182. And why do we use this data? What is this for? Just like with the cap rates, if you found an average gross rent multiplier in an area, and let's just for simplicity say this is the average in our area. If I was selling an investment property, as opposed to valuing it based on sales comparables and somebody wanting to live there, you could value it based on the money that it makes. And so let's say it's renting for $3,000 a month. I could say, based on the average gross rent multiplier of 182 in the area, I could take my rent that this investment property is going for each month and multiply it by the average gross rent multiplier. And that tells me I may be able to sell this property for about $546. That's all it is. It is valuing a property as an investment versus as something that somebody's going to live in, because it may be more valuable to an investor if it's making decent cash flow. But it's just so simplistic. We're only looking at a correlation for what it rents for versus what the other property, like what they sold for. That's it. The only other confusing thing about this is sometimes they'll do it for a correlation between the monthly rent, and sometimes they'll do it for a correlation from the annual income. And so in other words, in this example that I gave you initially, 4,000 and 2,200 gives us that gross rent multiplier. If we were to say 2,200 times 12, that is your annual rent of 26,400. So if you looked at it as a correlation from there, it's going to be a much smaller number. Sometimes they do both, but you'll be able to kind of see that on a question. So 400,000 divided by 26,400, that is the exact same as this gross rent multiplier. It's just one is looking at a correlation of the year and one is looking at the month. And so a lot of times this one's called a gross income multiplier. Sometimes they'll just say it annually. Sometimes they'll say it monthly. But all it is a correlation. So if you looked at the $3,000 times 12, now times your 15.15, you see we're still kind of dealing with the same number. I'm just showing you. Sometimes they correlate it from the annual. Sometimes they look at it from a monthly. Just really oversimplified. So this is just an example of like the annual income. I guess this could be rental as well. I guess you really don't know with this one depending on the type of property. What's your gross rent multiplier based on this? It's just your 82,000 divided by the rent, whether that be monthly or annual, it doesn't say, 10.51. And so let me show you how easy this is for like a test question that wants you to math it out, folks. Look at this. Using a gross rent multiplier of 15, what would be the suggested market value on a house grossing $7,800 in annual rent? Tell me what you got. So it's just your $7,800 in rental incomes times your gross rent multiplier. That is it. 117,000. So don't overthink that. It's just a much more simplistic correlation, only looking at the metric of what it sold for versus what it rented for, not any of the other more unique metrics that come into play with the income capitalization approach. Now, I already said this a little bit ago as well. When you're dealing with an appraiser never utilizes reconciliation. Never utilizes simple averaging, and they use a method called reconciliation. I told you sometimes they will use the sales comparison approach and the cost approach. Sometimes they'll use all three when appropriate, and they will do weighted averaging and give the most value to whichever one they think is the most accurate. Never simple averaging for those. It's called reconciliation that an appraiser does. That's why I showed you they arrived at that one conclusion of value. So I'll leave this slide up for a second before I ask the next question. No, that's Bree says, was the previous method considered part of the income cap method? No, the income cap method is its own thing. The gross rent multiplier is something similar, but not the same thing. Like I said, it's just a simplified kind of addition of it where it's just looking at the correlation of those two metrics. Nothing else comes into play. So we already talked about this. We calculate the NOI, and excuse me. I'll accept a couple answers here. How do we calculate NOI? Yeah, there you go. The effective gross income minus your operating expenses. I'm not going to make you do this one just because I didn't really focus on the T-bar formulas. So this is just dealing with the T-bar version of the income capitalization approach math, which we showed you. Value times your cap rate equals your NOI. NOI divided by cap rate equals your value, so on and so forth. How about this question? If the comparable property feature is superior to the subject property, we would adjust the comparable property price which way? There you go. Superior, subtract. We would subtract, or in other words, adjust the price down. And if it was inferior, we would increase or add. There you go. Which wraps up 17. But as I said, it's because, there's only so much we can say about it, but you definitely need to make it part of your studies to, remember the three different methods of valuation, the different methods of depreciation. There's just a lot to this section, but we can't spend a whole lot of time there with everything else we got to get into. But CMA stands for comparative market analysis, also called a BPO. It's where we determine probable sales price or probable list price. Of course, we talked about different forces that can influence value. Gross rent multipliers, we just talked about. Cost approach, income capitalization approach, and your sales comparison approach are your three different approaches to valuations. Now,